Hey guys, thanks for tuning in. Today I'm going to highlight three of the questions that I'm getting quite a bit from buyers right now. And that's, hey Danny, what direction is the mortgage market moving in? How are the rates trending? The second one is, how is this going to impact my purchasing power? And the third, of course, is should I buy now or should I wait? So I'm going to share two scenarios with you guys that'll hopefully answer those. And then ultimately, with the explanation, the third question will be answered whether or not you should wait. So the one thing I want to do is share with you what's been popular recently is the 2-1 buy down or the seller buy down program. And let me show you this. I'm going to use the example of a $650,000 purchase price, just because it's pretty common for that to be at the low end of most markets here in the foothills of Alta Loma, Rancho Cucamonga, Upland. But here's the thing. With a $650,000 purchase price, the way a 2-1 buy down works is you're asking the seller to pay your first 2 years of interest. So your first year, your interest rate is actually going to be lower in interest rate by 2%. So if you start off with today's rate of 6.75, your payments on year one are going to start at 4.75, and you can see that illustrated here. It's a huge benefit because it allows you to get comfortable with your mortgage payment, especially if you're a first-time home buyer. It's hard to get into this market realizing what these payments are actually coming up to. But you're going to have that 2-year window where either rates are going to come down in 2 years or you're going to be more comfortable. Hopefully, you're receiving more income at that point. But the benefit of the 2-1 buy down, you're not going to qualify at the lowest payment. You're going to qualify at what the rate is today. So don't think that we're going to qualify you for something you can't afford. That's not the way the program works. Okay, to destroy that myth, right? So your first year, your payment is going to be $44.74, which is exciting. So you have one whole year with that lower payment. The second year, your rate gets bumped up to 5.75, and then your payment goes up about $400 a month, 420 or so. And then your third year, after 2 years of having a lower payment, your third year, now it goes up to what the payment is today, right? At 6.75. You're at a $5,258 payment. That's with taxes and insurance and mortgage insurance. Now, here's the other option is if you say, hey, no, I want to buy 2 years from now, or I want to buy next year, right? Here's the thing. If the market moves, and this is showing a 2-year appreciation at 697, this new purchase price, right? So instead of buying the house at 650, if the market appreciates 3.5% or 3.6%, which is what Fannie Mae is estimating for the next 2 years, you're going to be buying that house at 697,000. Doesn't sound like a lot, but watch this. If you put the same 5% down and the rates are lower, let's say it's 6.25 instead of 6.75, that's a half a point drop. But look at your payment, 54.26. Okay, so I don't think it would have made sense at that point to wait the 2 years just to have a higher payment. Obviously, we can't speculate what's really going to happen. But if you're asking me what's the best way to get into a house with a lower payment, I would look at the 2-1 buy down. The second option I want to share with you is just buying the house now, expecting to refinance 2 years down the road. Hopefully the rates are lower 2 years down the road. A lot of people are expecting them to be lower. Fannie Mae is saying that by next year in the first quarter, we should be in the low sixes. Nobody has a crystal ball, but that's what Fannie Mae is suggesting, right? So they're thinking that we're going to be in the low sixes. Maybe in 2 years, we could be in the fives. So I'm going to use that as an example. So if you were to purchase the house now at 650 and you wait 2 years to refinance it, your potential payment 2 years from now is going to be $45.90, right? But look at this. So if your down payment right now is $32,500, after 2 years of payments, you're going to reduce your principal by $13,620, and then your appreciation would have been approximately $46,000, giving you a total net equity of $92,416, which is huge. That's a lot of equity in a 2-year period, and that's just with a 3.5% appreciation. So look at the opposite side of that conversation. If you were to wait 2 years to buy, so now you're buying the house again at 3.5 to 3.6% higher per year appreciation. Now you're looking at 696 purchase price. If the rates were 5.75 when you decided to buy, with the same down payment again, your payment is $51.18 a month. That's almost $600 more. So here's the difference. You're gonna have a higher down payment required because now you're putting 5% on a larger purchase price, which is simple math, right? But the sad part is you got zero principal paid in 2 years. You've probably been renting still this whole time, so you're not saving that money. Your appreciation is zero. The only appreciation you really have is your equity of what you put down is a 34,000, and that's 2 years down the road. So if you were to look at both of these and ask, should I wait? I'm going to suggest looking into this and seeing if it makes sense for you and your family. If you'd like to see what this looks like for you at your purchase price, you might be at a lower purchase price, you might be at a higher purchase price. I'd love to show you what the 2-1 buy down looks like for you, which is very popular right now. Or if you just wanted to buy down the interest rate permanently, let's connect. Go ahead and reach out.